Alright, let's get into what's driving the sudden spike in the 10-year Treasury yield. We all know that prices are usually determined by supply and demand, and bonds are no exception. When bond prices drop, yields go up. So, if the yield on the 10-year US Treasury is going up, that means there are fewer buyers than sellers, pushing the prices down and yields up. Diving into the details, several factors have led to this shift in supply and demand. First off, the structure of bond buyers has changed. Since 2008, the biggest buyers have been the Federal Reserve, foreign governments like China, Japan, and US commercial banks. These are entities with deep pockets, especially the Fed, which can essentially print money. During the pandemic, for instance, the Fed bought US Treasuries in unlimited quantities to stimulate the economy. This caused bond prices to go up and yields to drop. But now, these key buyers are pulling back. The Fed is tapering its asset purchases, and China and Japan are selling US Treasuries. With fewer buyers, demand drops, pushing bond prices down and yields up. Now that these major buyers are stepping back, hedge funds and other financial institutions have become the primary buyers. Unlike central banks, they don't have unlimited funds and need to be more selective. To entice them to buy long-term treasuries, you've got to offer higher yields, especially when there are more attractive investment options available, which brings me to the next point. Better investment alternatives are reducing the demand for long-term US Treasuries, thus driving up yields. Many people are now putting their cash into short-term deposits with higher interest rates and lower risks. There are also high-yield cash-saving ETFs that are way more convenient than buying bonds. These attractive short-term options have lured away investors from long-term bonds, pushing down prices and bumping up yields. You might wonder why the influx of money into these high-yield short-term assets isn't pushing their prices up and yields down. Well, that's because we have a seller that doesn't care about cost, the Federal Reserve. The Fed's interest rate policies have finally permeated the market, affecting both short-term and long-term rates. The Fed directly influences short-term rates by changing the interest rate it pays on reserves held by commercial banks. This gets passed on to consumers through higher or lower interest rates for loans and deposits. The Fed can afford to pay higher interest because it can print money, and it operates under a different accounting system that allows it to pay out even when it's losing money. So when there's a superseller like the Fed that can pay ever-increasing interest, even an influx of money into short-term assets won't easily drive yields down. The market expects the Fed to maintain high interest rates for a while, making people more inclined to invest in short-term assets. This further reduces the demand for long-term bonds, dropping their prices and pushing up yields. Lastly, while demand has reduced, the supply hasn't. The US government continues to borrow heavily, and the rising interest rates force it to take on even more debt to pay off older debt, creating a vicious cycle. Put all these factors together, and you've got a situation where supply outweighs demand, driving bond prices down and yields up.